Hi, if you follow our weekly market minute piece, you know that the market's been very concentrated in 6 different high-tech names, mega cap names. That's been leading the market up. That's almost the entire performance of the S&P 500 this year, and the NASDAQ as well, mostly. But it's been a very narrow market. On Friday, when the debt ceiling was passed, we got a nice broad-based rally. So it's the first time we've seen that all year long, really. So we think we're at the point where we might see some broadening in the market, and then some maybe pretty explosive performance in the Russell 2000 and the equal weighted S&P 500. So the chart here is the Russell 2000. You can see that it went above the 200-day moving average. So very nice, right? Broke above the 20 and the 50-day prior, now above the 200-day. Not sure if it can hold that, but we're watching it. So generally speaking, if the 200-day is in a positive trend and the market's above the 200-day, then it's in an uptrend. So that's what we ultimately look for in buying different indexes on a technical basis. We think that the Russell 2000 is very undervalued, 50 to 100% undervalued. On a 3-year hold, there's a lot of upside in this particular index, as well as the equal weighted S&P 500. Now, I mentioned Friday there was a broad-based rally, 2,500 stocks up, 400 stocks down. That's very nice. Come Monday, it kind of went the other direction. So the leadership was the mega cap growth stocks again, technology stocks, and the laggers were the S&P 500, equal weight, and the smaller Russell 2000 names. So what we'd like to do is buy these sectors when it's coming out of recession, or when the market decides maybe they're more confident in the overall economy and allows us to buy those positions and have at least a nice trade out of it. Trade meaning a 6-month sort of position where we can make very significant money. So we're watching to see if the market is believing that this rotation will occur, and if it does, then we're going to increase our positions into these type of indexes. So looking at the Russell 2000 from 2015, I wanted to point out that you had these massive moves. Okay, so we all know we went through this major correction in 2020 with COVID. The world looked like it's coming to an end, then it snapped right back. But look at this snapback in this. So not only did it go back to the old high, it went up 125% in short order. Now it's corrected in a big way. It's flirting with the 200-day. Again, if the market can come to grips that we're not going to have a recession and the rotation is on, this sector is going to move big. If we're stuck in the recession scenario, which unfortunately that's kind of where we're leaning, that there will be a recession, then everything's going to come back down in price. Perhaps the Russell 2000 and equal weight's a little less than the mega cap tech stocks, but everything will come down in price. I just want you to remember that Apple, great company, highly valued, somewhat of a slow growth rate at this point. So it's 30+ times earnings. It's going to grow maybe 10% a year. Highly valued. It is, the market cap of Apple is larger than the 2,000 stocks in the Russell 2000. So if the market decides to move in this direction, if the big money decides I need small cap exposure, the performance is going to be explosive. Now, this is the federal debt. This is what's kind of concerning us near term. The market kind of got over this quickly, with the debt being passed in terms of the limit being passed by Congress and signed by Biden. The debt has been stagnant now, not growing, which is great, but it's now going on 8 months where the Treasury could not expand the debt. The deficit this year is going to be $1.5 trillion, okay? And we've gone 8 months without increasing the debt. So the Treasury wants money in such a bad way to pay all the upcoming bills and past bills they may have deferred. So yes, deferred. So that $1.1 trillion is what we expect that they will come out and need over the next 4 to 5 months. That is a lot of borrowing in a very short period of time. Perhaps it might even be shorter. We're not sure. So this is going to put pressure on the bond market and also the stock market. So also there's $95 billion that's rolling off the Federal Reserve's balance sheet. That adds up pretty quickly as well. That's an enormous amount of money as well. So the bond market and the stock market may be pressured in the short term by all this massive borrowing that the federal government needs to do to get caught up. And actually longer term, it's not a really positive scenario either, but right in front of us is the debt ceiling catch-up that needs to be done. Now, the top 6 companies in the S&P 500 and the top 6 technology companies have increased this year a total of $3.3 trillion. $3.3 trillion. Okay, that's massive. The amount of money that was held back from the government borrowing, so the amount of money they did not borrow, was roughly $1 trillion. So we're thinking because that money wasn't soaked up by the market, it probably went into stocks like this. These are only stocks that really worked. So that free money went into what I would call more or less sure things in terms of fundamentals. Very liquid. People could get out when they wanted to. So that was kind of a knee-jerk reaction as that money was available. The debt ceiling money that the Treasury could not borrow was available to go into the stock market, and it flew into these 6 different companies. So we think when the Treasury has to go out and borrow that money again, perhaps that money is coming out of these type of names. Or it's going to come out of maybe other Treasury securities or debt securities. So we would likely see some borrowing pressure occur in the bond market and also some liquidity issues in the stock market. Now, debt is a problem. It's becoming a big problem for the consumer. It's a problem for the Treasury financing. Could be a problem for the stock market as there's too much debt in the economy, and it's going to slow the growth of the economy. Certain sectors will do okay, but the debt is a problem. I want to show you here the consumer debt. Okay, so this is where everybody was saving money in the pandemic. So consumer borrowing really declined in a big way. We are so far past the peak, what it was in 2019 now. We think we're at the breaking point of the consumer not really being able to borrow anymore. We think the credit cards are getting maxed out. Perhaps they need to go back to work. But this is a problem. There's too much debt. And then on the student loan side, again, same way. Massive increase in student loans. Of course, why not? If the government's going to give it away for free. But that doesn't look like it's going to happen. The student loan forgiveness program has been more or less repealed by Congress. They passed the bill. It's going in front of Biden. Biden's likely going to veto it. Then it'll go to the Supreme Court. The Supreme Court says what Biden did was unconstitutional. And by year end, you're going to have $500 billion to $1 trillion that those students will have to pay back, or prior students will have to pay back. So they have to pay that money back. Again, it'll cause some consumer spending issues. We are clearly seeing the retailers report very disappointing quarters, and it's blamed on inflation and consumers focusing on more of the day-to-day staples rather than anything discretionary. So not sure if we're going to get the big rotation but we know, very confident in saying this, we think we're at the point where those 6 technology stocks cannot go up much more from here. So they were looking at a possible correction in those names, and the market going lower, because that's the only thing that drove it. So when the market corrects, they're going to take profit where they have it. And we're at the point where those names are getting too expensive. The market needs to rotate. The S&P 500 is currently valued at around 15 times earnings if you do an equal weight. If you do a market weight, it's over 19 times earnings. So the underlying market is fine. It's just when you weight it all up with these very highly valued stocks, it's not. And so if the market decides to correct, it's going to come out of those highly valued technology stocks. And so maybe on the next leg up, we see a rotation. If not, if the market decides it's more comfortable with the economy, not sure it will be, but if it decides that that's the case, then you're going to see a rip-roaring rally in the Russell 2000 and the equal-weighted S&P 500. Thank you very much. If you would like to subscribe to this, hit subscribe. You can sign up for the hard copy of the Market in a Minute. We send it to you in an email, and for whatever reason you'll get the email. It's good to be subscribed to the video. Thank you, and take care.